Welcome to Great Points, financial insights for improving your relationship with money. I'm Matt Schroeder, certified financial planner and director of financial planning at Great Point Wealth Advisors, a fee-only registered investment advisory firm with offices in Boston and Danvers, Massachusetts. Today I'm joined again with my co-host, Brandon Parker. Welcome, Brandon.
Hey, Matt. How are we doing today?
Doing great. Looking forward to a very exciting topic today of insurance. I know everyone's favorite topic, but we've been talking a lot about reviewing your goals, talking about what to do if you're considering a career change. So we're coming into that season, being into the fall. We're getting into open enrollment season. So a lot of you are starting to get an email saying open enrollment is for these 2 weeks. If you need to make any changes, please do so now. If you don't want to make any changes, just ignore this email. So I thought it'd be a good time to kind of review what goes on during an open enrollment. What are some of the insurances that you might have through work, that you might have through personal, and help you kind of come up with a homework exercise that kind of will start to make sense of it. So, Brandon, your last job, when open enrollment came, I know there's not a scientific number, but how many of your employees or people that work for you were 100% confident they knew everything that was available during open enrollment?
Yeah, it's always surprising, especially you get at some of the bigger firms, they have a lot of different benefits. So the obvious ones are things like, being enrolled in your 401k and then, health insurance. That annual enrollment period in the fall is kind of the time you can make any changes you need to make. You'd be surprised. I mean, folks a lot of times kind of set it and forget it and don't really think about it. And then, that opportunity in the fall where you can make changes kind of passes by and they're like, shoot, I should have taken a little closer look to see what other options are out there. Especially, as life events kind of change, whether you get married or you have children or you move, all of those things can impact, the health plan you have and, what benefits you might need.
Right. Yeah. So, obviously there's some big ones, health insurance probably being the biggest and most important one. So why don't we start there? When you're thinking about health insurance, we don't really get into advising clients on, hey, you need health option A or health option B, but really what we help them think through is kind of the out-of-pocket exposure. So ultimately with any type of insurance, the question you have to ask yourself is, if I didn't have this insurance, what's the worst case scenario? So in Massachusetts, you're required to have health insurance, but hypothetically, let's say you didn't have health insurance and you got into a car accident. You see some of these medical bills, they're hundreds of thousands of dollars. That would be catastrophic to almost anyone's financial livelihood. So health insurance is something you need to have, but understanding kind of your options, there's HMOs, there's PPOs, there's, high deductible HSA accounts. So, understanding what's right for you is kind of, is something you want to spend a little time on. Usually it comes down to how healthy you are. So if you're the type of person that, unless you get injured, you're not really going to the doctor a whole lot. You do your annual physical, you keep yourself in good shape, you work out, you're not taking any regular prescription drugs, things are pretty basic. You might try to look for the plan that has the least out of pocket for premium. So when it comes to health insurance, first thing you have to do is you have to pay your part of the premium. And if you're working for an employer, sometimes they cover 50, 70, 80% of that. But usually on your pay stub, you see, health insurance, $200 or $87 or whatever that number is. If you choose the plan that costs maybe $100 more, the reason you're paying more in your premium is because there's less future cost if you were to need those services. So, you kind of look at yourself and say, well, I'd rather have the extra $100 because if, I'll use myself. If I went and did the math and said, well, if I needed a medical procedure and it cost me $11,000 and I have a maximum out of pocket of $8,000, I would kind of be capped at $8,000. So I know if I got hurt, I'd have to pay another $8,000. But my monthly premium is $1,000, is about $1,000 less per month. So I'm gonna not pay $12,000 in premiums for the chance that if I get hurt, I wouldn't have to pay $8,000. But I also have there's 4 other people in my family. So if 3 of us needed significant medical bills, I would now have to pay $24,000. So I'm looking at the math and saying, well, should I pay an extra $10,000 in annual premiums, and not have to take the risk that I might owe $24,000, or do I keep the money in my pocket and take the risk? So if you're the type of individual that might have some extra cash in the bank or you have some savings built up, you might take that risk. If you're the type of person that maybe is struggling or has debts and you're kind of living a little bit closer to paycheck, you might steer towards pay a little bit more now, but have a lot less out-of-pocket expenses. So when it comes to health insurance, the other question we get a lot is should I put money in my HSA? Brandon, someone that says, hey, should I put money in my HSA? What would you tell them?
Yeah. So first of all, the HSAs, you have to have what's called a high deductible plan to be eligible for them. So basically what that means, Matt talked about the maximum out-of-pocket number, but the deductible will be the number that you essentially will have to pay on an annual basis before insurance starts kicking in. So if the deductible is, say, $5,000 a year, you'll be responsible for the first $5,000 to an extent before insurance starts to really cover beyond that. So it's kind of an emergency type of plan where it really does kind of incentivize you to want to save a little bit more in the short term. So that's kind of where that HSA can fit in. If you'd rather not pay a really high premium, you can get a higher deductible so that you can save towards future health expenses if you need them. So the HSAs are a pretty cool financial instrument, and they're relatively new. I mean, I think in the last 20 or 30 years, they've really started to come in. And basically, there's a few major benefits. One of them is that money is yours. It doesn't go away. So, a flexible savings account goes away at the end of every year versus an HSA, a health savings account. You can carry over indefinitely. So it's just another way to be able to save for long-term expenses and long-term future. And if you ever use that money on healthcare expenses specifically, it's tax-free. So it comes out of your paycheck before you're taxed. And then if you withdraw it anytime down the road for a health expense specifically, you don't get taxed on that money either. So you could be investing it the whole time, and even if it's grown a lot over the years, you're still not taxed on that as a capital gains situation. So there's some really nice financial benefits. As Matt said, though, if you're supporting a whole family, it may not make sense to be that high deductible where you have a lot more cash out of pocket because it's more likely that you're going to have those expenses in any given year. So those are kind of some of the things to think about. But if you are eligible for an HSA, definitely recommend some contributions there and look through the bigger picture and see how it fits in your plan, because it's a really powerful savings vehicle. It's what they call triple tax advantage. So if you then retire and you have a balance left in your HSA, it gets treated pretty much like an IRA does. So you actually get that tax advantage on your investment growth over time, and then you can use it for different things later on. But it's always tax-free for healthcare expenses, which is really powerful.
Right, and it's likely that over the next 30, 40, 50 years, you'll have some form of medical expense that you can use it on. So it's unlikely that you'll be stuck with this account that you have to take out and pay taxes on. So, health insurance is obviously a big one. It's something everyone should have. If you're under 26, you might be able to still get on your parents' insurance. You might do the math and say, hey, my employer offers it, so I know I can be on my parents' plan a little bit longer, but maybe I should give them a break, pay my own insurance. They can then start putting money away for their future again. So just because you can be on your parents' insurance doesn't mean you should leave them with the bill. Maybe have that discussion, do your research, see which plan's better for you currently long term, and maybe start to move off the family payroll. I'm not speaking to my kids for 6 or 7 years in the future. Hopefully, we'll be having this discussion. So the other one you'll see is like life insurance. So and there's two different types. Usually, there's two boxes. There's life insurance, and then there's accidental death and dismemberment. So if you are 24, no kids, no mortgage, should you have life insurance? The question is, do you have student loans? Do you have other debts that might have to be paid? So you might want to have a little bit of life insurance, through your job. But you don't necessarily want to be paying a lot of money for life insurance if you don't have a lot of bills to pay. But the difference between life insurance and accidental death and dismemberment, because when you look at it, it says, life insurance for $100,000 is $9 a paycheck. And accidental death and dismemberment for $250,000 is 22 cents a paycheck. So I'll just buy the one that's 22 cents versus the one that's $9. But the fact is, accidental death and dismemberment only pays out in very, very unique situations. So you're traveling for work in a plane crash or a car accident. You lose, one limb or only half a limb. There's different. It's really a terrible underwriting process. But they're not the same. So just because you have accidental death and dismemberment, you really don't have life insurance, because life insurance covers you. You get sick, normal life events happen, you pass away, someone's going to get paid. Versus accidental death and dismemberment, you kind of have to win the parlay bet to be able to get that paid off. So, it's cost less to the insurance company because they don't pay it out very often. So life insurance, couple little tips. Whatever that dollar amount is, it's usually per paycheck. So if you get paid 2 times a month or twice a week or once a week or 4 times or once a month, the cost is going to vary. So you look and say, well, it's only $4 a month, but it's really $4 a paycheck. So if you're paid weekly, that's now $16. And usually the way life insurance through work is designed is it's usually in 3 to 5 year increments. So from 31 to 35, you pay one price. From 35 to 39, you pay another price. So if it's $4 today, and you happen to work at that company for 10 years and don't pay attention, it's probably costing you $28 a paycheck 10 years from now. So with life insurance, you always want to ask the question, should I buy it through work, or can I get it better? Should I get it from in a private insurance for myself? So you might, if you are, you're buying $250,000 of life insurance through your work, you might do an online search and say, what if I bought $250,000 of life insurance personally? What would that cost me? Because if you buy it personally, the premium is usually fixed for 10, 20, or 30 years. So, even if I change jobs or, situation, my health changes, I've got that coverage locked up. And maybe for an extra, what works out to be $3 or $4 a paycheck, it's worth having that security. If you don't really need the insurance and the company's giving it to you, and you're obviously going to take it, it's free. So you don't really have to spend a lot of time thinking about that. But look at the monthly costs as well as life versus accidental death and dismemberment. The next one is disability insurance. Brandon, what does disability insurance cover?
Yeah. So disability insurance, comparing it to say life insurance, they serve a little bit of a different purpose, where disability insurance is really meant to, cover any expenses you might have in case of not being able to work. So, due to injury. And there's a couple different forms of disability insurance. You might see short-term, you might also see long-term. Short-term typically would be something like, I need to miss time to have knee surgery and I can't be on the job. Versus long-term, it might be something much more chronic illness or anything that's, an extended period of time that you'd have to be out of work, and it would provide some income for you while you're out. So ultimately, a lot of the questions come from, how healthy you are, if you have pre-existing conditions or other things along those lines that might come into play. Then you start to look a little bit more detail about what you really need to replace, what income you need to replace. So, similar to life insurance, if you have a mortgage or if you have dependents, whether the children or, might be parents or somebody that you need to support, in case something does happen to you, that insurance can kick in to help cover some of those expenses.
So if you get disabled on the job or outside the job, do you still have to pay your student loan bills?
Yeah, it's a great question. Student loan bills, I believe it's yes, right?
The answer is yes.
This is a quiz for me, folks.
Correct. So even if you if you have those debts, that's one of those things like, I don't want to start accruing late penalties and interest. So, and the way disability insurance works through your job is on open enrollment, there's 2 important things you have to check. One, to Brandon's point, there's short term and then long term. Long term is kind of 90 days plus, 180 days plus. So the odds of it happening, most say, I'm never going to be out of work that long. But statistically, there's a 1 in 3 chance that before age 65, the average person will have a disability lasting more than 90 days. So we all hope it never happens, but it's definitely something you at least have to think about. And the reason why when you look at the line item, disability insurance costs more than life insurance is because you're more likely to be disabled and over the course of your work than die prematurely. So once again, the cost aligns with the chances that you might need it. So, but with long-term disability, usually there's a box on there, and sometimes you have options. It covers like 50% or 75% of your pre-tax income. So let's use the example: you're making $50,000 and you get disabled and you don't have insurance, you go to making zero. If you have 70% income replacement, you would then start receiving $35,000 in the form of disability benefits. But sometimes there's a box on there that says, should my disability premiums be pre-tax or after-tax? So if you check pre-tax, that means you get a small tax incentive on the money that gets paid for the premium. But the problem is then when you receive the benefit, it's now taxable. So you were making $50,000 paying taxes. Now you're making $35,000 in paying taxes. Versus if you check the box that says, no, make it post-tax, that means you pay a little bit of tax on the premium they take out, but the benefit would be income tax-free. So now all of a sudden you're making $35,000, but you're not paying any taxes on that $35,000. So it would stretch a little bit further. So it's this little minuscule box that most people don't think about, but it's definitely one you want to ask, if I got disabled, will my benefit be pre-tax or will I have to pay tax on that benefit? And ultimately you want it to be pre-tax. So do whatever you have to do to make sure that your benefit when you receive it, I'm sure not pre-tax, but would be tax-free. So disability insurance, it's a really hard topic. Once again, if you have other things besides just student loans, like I said, you've got a mortgage or you haven't built up a lot of savings and you're living paycheck to paycheck, even a 70% reduction would be painful. So sometimes you might have to look at buying a supplemental plan outside of work that might cover that extra 10 or 15% gap. Ultimately, insurance companies are not going to let you make the same amount. They're never going to let you get close to 100% of your pre-tax income. Because then if you got disabled, their argument is you'd have less incentive to go back to work because you're basically making the same amount of money for not working. I kind of disagree with that idea. Most people ultimately want to get back to work and get back to normal life, but that's the reason why you never get to have 100% disability insurance because of that process. So you get life insurance, you get disability insurance, then you start moving down the line. And there's sometimes, depending on the size of your company, you might see these legal coverage or pet insurance. Have you anyone had to deal with pet insurance?
I haven't personally, but I've seen pet owners that it might be their lab swallowed a sock and can't pass it. All of a sudden you have to go in for surgery. So it's a real cost. I mean, I think all pet owners probably understand, what can happen, but it's a unique benefit a lot of companies are going with now because of, being able to support their people and, be able to, kind of support the pet friendly world. So that's an interesting one. It's a fun one.
Yeah, and it's definitely, and some employers will offer it. So if you're working for a larger organization and you do have a dog or a pet, you might want to look into it because maybe it's $12 or $15 or $20 a paycheck, and there's no tax incentives to you. You're going to pay tax on the benefit, but the cost of some of those procedures can be expensive. So, and I don't have any pets myself, so. But for the people that do have them, they tend not to want to say, well, he's had a good run. We'll just not do the surgery. Most people are going to do the procedure and have to find a way to pay for that $2,000 or $2,500. So with anything like pet insurance or some of these smaller coverages, the only thing you have to be very careful of is what does it cover. So you might thinking, well, if my animal gets sick, no matter what, I'm covered. Then you realize, well, that isn't covered. That's partially covered, and they didn't swallow the sock at the right time of day, so now all of a sudden you owe us 33% instead of 0%. So you want to just understand what it covers, what type of dog, what type of pets you have, and make sure they're insured. Another important one is legal coverage, and we've talked about this a little bit in the past, but sometimes there's a what's called a legal prepaid plan, and usually people blow right past it. They don't even think about it. They're thinking, I'm not going to get arrested or sued or whatever. But Brandon, if someone's wondering what that is, what might that cover?
Yeah, so it's kind of a nice benefit for some companies, and we've talked with clients at times about if you have legal coverage to your company, could that go towards drafting an estate plan or writing up a will? So things that ultimately most folks will have to do at some point in their life. So those kind of plans that can help you with that can actually come in handy in that kind of situation.
Right. Yeah. So if you are maybe a married couple or a younger professional who might have some assets or a house, that legal benefit is usually like $7 to $10 a paycheck or a month. But the cost of just drafting a basic will and estate documents is usually $1,500 to $2,500. So if you don't need the works, you just need to have something in place. Maybe you have a child and you're worried about guardianship. That legal benefit is something you could sign up for, get your will done, maybe keep it the next year, maybe not. Maybe you kind of do it year by year. But I've talked to people that they lost a very nice jacket at the bar and they called up and they through the legal benefit, the person was able to file a claim and get them some money. So it's one of those ones you don't think a lot about, but if you are things happen, so you might want to just read that one a little more thoroughly if it is offered. So I was just doing a quick tally when it comes to kind of a homework exercise. I kind of wrote down all the possible insurances someone who's in their 20s might be paying for. So I wrote down life insurance, disability, health insurance, maybe a legal plan, maybe pet insurance, maybe car insurance, and maybe you pay the insurance on your phone or your iPad and all the technology. If you have a home or rent or you're renting, you might have rental insurance or homeowners insurance. And maybe there's more, but I kind of tallied those up and put some very rough numbers next to them. But it's not crazy if you're and if you're owning a home, it's probably a little bit more expensive than you're renting. But even as a renter's insurance, you might be paying $500 to $600 a month in insurance costs to kind of fully protect yourself. And you don't really feel it because it's like $4 here and $11 here. And a lot of them come off your paycheck and you're only dealing with the net paycheck as kind of what you feel is your money. So you maybe don't think about all these. But what I would really encourage everyone to do, a little bit of exercise, is go through your pay stub, go through all the things you pay insurance on, and just make a list and just say, oh, that cost me this cost me there. And do the math to convert it to an annual cost. So if you're paying $4 a week, $16 a month, $200 a year. So do them all out to an annual number and just see how much am I paying out in insurance. And then go back to that question we mentioned earlier, which is, if I didn't have this insurance, what's the worst case scenario? So, we bought my son a laptop and they said, the laptop, let's say the laptop was $1,000. Do you want the 2-year consumer protection plan? It's $150. So I looked at that and said, well, that's 15% of the cost of what I just bought. Hypothetically, if this laptop were to break, could I afford to buy another one? The short answer is yes. So do I want to pay $150 and hope he breaks it and I get my money back that way? Or do I want to keep the $150 in my pocket and say, worst case, I have to pay another $1,000, but I trust he's going to take good care of it. So in that situation, the worst case scenario was not that great, not that risky. So I chose not to buy the insurance versus, Brandon, you own a home. Do you ever think about not carrying homeowners insurance?
I don't think my mortgage provider would like that much, but yeah, it's one of those things. I mean, the value of your house is what you could lose, right? So if you're not insured to cover part of that, that would be catastrophic. It's something that, it's painful to even think about, right? But that's where the value of insurance can really show up is, all right, if something did happen and, God forbid, the house burned down, would we be able to recover? Without insurance, maybe not. Probably not, if we're being honest. So
right, yeah. So that's the idea: is could I afford? What would be the worst case scenario? And that's answer that question. So, like I said, you've got your list. You see all the things, and now what you don't want to do is just start crossing them off to save money because that could be not very wise. But what you do is you want to go line by line and just say, do I need it? Do I need this amount, or should I have more or less? Because in some situations, take car insurance. Let's say you've done a good job saving, you've built some money up, and you've got $100,000 saved, but you still have the same kind of basic car insurance that you got right out of college, and has maximum coverage of $25,000 or per incident. So all the insurance company is going to provide is that. Technically, you have other assets. So if you were to hit somebody or get into an accident, they might be able to attack your other assets. So usually you want to review your deductibles, make sure they kind of align with what you have. So in that situation where you're worth more than what your insurance will cover, you might actually need more insurance. Vice versa, if you're paying for deductibles that are higher than you might ever need, you might need less insurance. So it's just, you still need the insurance. You just might need a different level of it. So, do I need it? Should I increase it? Should I keep it the same, or should I reduce it? And then the final question is, if I don't need it, should I eliminate it? And if I eliminate it, can I take that money and kind of put it towards something more effective, either for my long-term goals or for savings or reducing a debt or something like that? So, as I mentioned, this is not the most exciting topic, but insurance is something that if you spend 1 hour a year thinking about, you'll probably be further ahead than 90% of your peers, because most people never think about it. They just click the button that says, nope, I'm good, just roll it over. And then something happens mid-year and they're like, oh, I didn't know. Can I get back on that deal? Was that deal still there? And the answer is no. Most people want insurance when they need it, and that's too late. So take an hour this year before open enrollment, go through all the selections. If you don't understand something, ask somebody. So ask someone, maybe a peer or mentor who's a little bit older, who's gone through it. Sometimes when you ask HR, they can't give you advice because legally they have to, if you tell them to do it or not do it and then it doesn't work out, the company's liable. So HR will probably tell you exactly what the benefit is, but they're never going to give you advice on whether you should or should not do it. But use the tools that are available to you and ask a lot of the right questions. So, like I said, 1 hour a year will really put you a lot further ahead than a lot of people that are out there. So, Brandon, any closing tips when it comes to insurance?
No, I think you summed it up really well, which is, again, it's a little bit of forethought can go a long way, and hopefully you never need it, but you never know what can happen out there.
So one, I guess I don't know the answer to this question that I'm going to ask you, but travel insurance. You're hearing more things. What's your take? If you were booking a trip, overseas trip, are you buying travel insurance or are you taking the risk?
Yeah, this is another one where the fine print matters a little bit. Take a look at what it actually covers. In a lot of cases, it's things that are extremely unlikely. Hopefully your trip doesn't need it. But at the end of the day, it's kind of a value question. Is it likely that an earthquake is going to stop me from going to somewhere in Asia? I don't know. I have no idea what the numbers are on that, but it's pretty unlikely, I would say. So those are generally not a very good deal.
Yeah. So ultimately, like they said, they're focusing on the worst case scenario, and same idea. If it's can you afford to lose the trip? So I'm still 50-50 on whether or not I'm doing it or not, just because every trip's a little bit different and unique, and some cost more than others. So you kind of have to have that pain point. So hopefully we made insurance a little bit interesting. Hopefully we motivated you to take a little bit of action, as opposed to just kind of clicking the button and ignoring it. And hope you enjoyed listening. So until next time, I'm Matt Schroeder. Well, once again, thanks all for listening. Thanks for tuning in. I'm Matt Schroeder with Great Points. And until next time, have a good day.